As a financial advisor since 1992, I've had the privilege of helping countless people navigate the complex world of investing. And throughout my career, there's one question I've heard probably more often than any other, and it's how can I keep my money safe? I can't afford to lose any. It's a perfectly understandable concern. After all, nobody enjoys losing money. But here's the catch. When it comes to money, the real conversation shouldn't just be about safety. It should also be about the purpose of your money and the time frame in which you need it. So before we dive in, I want to remind you that the advice in this post is purely educational. It is not personalized financial advice. When creating an investment strategy, it's essential to consider three time periods. Short-term goals, which is 1 to 2 years. These goals might include saving for a vacation, a car, home repairs, or building an emergency fund. The money for these goals should be kept in highly liquid, low-risk assets. Think like savings account or high-yield savings or CDs. These options tend to have minimal returns, but they preserve your principal and they ensure that the money is there when you need it. Now, midterm goals are somewhere between 3 and 6 years. These goals might include saving for a down payment on a home or funding your child's college tuition. The money for these goals should be kept in a balanced investment approach. Typically, this is a mix of 40% income, savings and bonds, and maybe 60% equity mutual funds or exchange traded funds. This allows for both growth and preservation. It's helping you weather some of the market volatility while also achieving your goal in the intermediate future. Now, long-term goals, those are 10 years or more. Retirement planning is the most common long-term goal. So if you have 10 or 20 or even 40 years before retirement, your portfolio should be more heavily invested in equities. Could be stocks, could be mutual funds, it could be ETFs, since they offer the best potential for growth over time. And then as you approach retirement, you can start shifting to a more balanced portfolio by increasing the fixed income investments. Now keep in mind that after retirement, your portfolio still needs to continue to grow so that it can distribute income for another 25 years or more. The key question or reasoning behind staying invested in equities until your last decade before retirement is pretty simple. Market corrections recover faster than most people think. Market corrections happen on average about every 2 years in a correction of about 13%. And those recover on average within 4 months. The more significant market crashes, like the one we had in 2000, 2008, they saw a decline of about 50%. And those markets took 6 years to bounce back. And thus the reasoning behind shifting your allocation within the decade before retirement. Now that we've broken down the different time periods, let's talk about why aligning your strategy with these time frames is critical. And what external factors impact our results? Inflation. It affects all of us. Whether you're looking at rising prices for housing, for food, or gas, if inflation runs at 6%, it means that in just 12 years, the price of goods have doubled. For most of us, wages aren't keeping up with inflation. And those on fixed income, the situation is even more challenging. So to keep pace with inflation and maintain your purchasing power, your investments are going to need to at least earn the inflation rate to break even. That's why it's crucial to ensure that your money is working for you, not just sitting in a savings account. Why do the rich keep getting richer? Just one word. It's compounding. Now, compounding is the process of earning interest on both your initial investment and the interest that's already been added to it. Here's a breakdown of how compounding works at different rates of return. The high yield savings account I mentioned, say 4% annual return, your money doubles every 18 years. A balanced portfolio, 7% return, your money doubles in just a little over 10 years. In more equity-focused investments of 10%, your money doubles approximately every 7 years. So let's use an example. You invest $50,000 today, and you leave it alone for 30 years. At 4%, it grew to $162,000. At 7%, it grew to $380,000. And at 10.2, which is the average return for the S&P over the last 60 years, it grew to $921,000. To think about this in the simplest terms, let's look at how doubling works. 50,000 doubled to 100,000. Then that doubled to 200,000. Then that doubled to 400,000. And lastly, it doubled to $800,000. You actually earned more in the last 7 years than you did in the first 23 years. And then go out another 14 years at 10%. It doubled to 1.6 million. That doubled to 3.2 million. I think you're getting the idea. So the difference in returns shows how important it is to invest in growth-oriented assets for the long term, to leverage compounding fully. Now, going back to the original concern, I want to keep my money safe. So there's a balance to be struck between preserving your principal, but also ensuring that your investments grow enough to keep pace with inflation and to benefit from compounding. The truth is, by playing it 100% safe in low-yield accounts, you may be risking your financial future. Over the long term, the erosion of purchasing power due to inflation and the missed opportunity of compounding could actually leave you with less money than you started with. It's essential to tailor your strategy based on your time horizon and your risk tolerance. Everyone's financial situation is different, and risk tolerance varies from person to person. The strategies mentioned here are meant as guidelines. Your financial goals they require a more personalized approach. And that's why working with a professional financial advisor can make all the difference. They can help you tailor your strategy to ensure you're making the best decisions to achieve the life that you dream of. I hope this post has helped you understand the importance of timeframes when creating an investment strategy. Stay tuned for more insight in future posts, and I want to thank you for joining me today, and let's make it a prosperous day.